Question 2 was a little bit different in that you were given some information and then asked to talk about what that information might have done to some indicators. And in particular, it was these ones here. So the following information relates to Bob's bikes from 2021 to 2022. We've got the cash flow cover, the debt ratio, and return on owner's investment. And what happened was, in addition to this info, it tells you the owner purchased a van in order to make deliveries to customers. The van will be depreciated at a rate of 10% on cost under the straight line method. The owner provided the following document, which is this one here. The money to purchase the van was financed with a loan. So this is for 2022, so we can see towards the beginning of 2022, we bought a van for $60,000. It's a delivery van, so that would be able to be used to make deliveries to customers. So when we sell something, we deliver it to the customer. Or it could be used to deliver things to us. We pick it up from the supplier, either way. What's important to note is that these three indicators have changed, and we're trying to figure out what impact this document here might have had on that, but also the fact that the van was financed with a loan. So before we do that, we should probably go through what each of the indicators mean. So we've got the cash flow cover, and that is our net cash flows from operating activities divided by current liabilities. And what it tells us is for every dollar of current liabilities the business has, this is how much cash the operating activities generate to pay them. So what does all this mean? Well, it measures liquidity, which is our ability to pay our short-term debts as they fall due, because it's got current liabilities in it. And specifically, what we want to think of is this one's telling us if I've got $1 of current liabilities to pay today, just say one here, where do I get the cash to pay for it? And we need to know our cash flow statement. And it says there's only three sections. There's the cash flows from operating activities, in which case the money would come in here. There's the cash flows from investing activities, in which case the money would come in here. Or there's the cash flows from financing activities, in which case the money would come in here. So we probably need to revise what each of these sections are. So to jog our memory, operating activities would mean that the cash was generated from day-to-day trading of goods and services. So we sell goods and services, we collect the cash, we have to pay for our expenses, stuff like that. And this is the good pipe. That's the pipe here that we would like to pay our bills from, because it means we're paying the liabilities that have been incurred from running the business with the cash from we generate from running the business on a day-to-day basis. Now, if it came in through the investing sections pipe here, that would mean we've sold a non-current asset, which could be good on its own, but if it's something we're not using. But then the asset is gone. It's gone forever, and we can't use it to generate future cash. Or lastly, we could pay this $1 of current liabilities from our financing activities. And the only two options there to get money in through this pipe are either to get a loan, that's bad because it increases debt and increases interest to be repaid, or the owners made a capital contribution, and that's a limited source of money. That the owners haven't got unlimited money, and when you go into business, you expect to take money out through drawings, not to contribute more and more capital. So what does this indicator here tell us? It tells us in 2021, the cash flow cover was 3.6. This means that if there was $1 of current liabilities here, this pipe for operating activities was generating a very healthy $3.60 cash from operating activities to pay it. So that is excellent. Now in 2022, this seems to have gone down quite a bit. So by 2022, for every $1 of current liabilities we have, this pipe here for operating is only generating $1.50. So our liquidity has declined here. We're generating much less operating cash to pay our current liabilities. However, it is still quite good. It is more than 1, which is kind of our minimum cutoff, but it's nowhere near as good as it was in the past. Let's look at our next indicator, which was our debt ratio. What does that measure? Well, it's total liabilities divided by total assets, and it tells us what percentage of the firm's total assets have been financed by debt or liabilities rather than with equity. And this measures primarily stability, but it also measures liquidity because it's looking at liabilities and assets. It's just a bit more long-term. Liquidity, short-term debts. However, part of your total liabilities and total assets will be current, so therefore it does measure liquidity as well. What is this one telling us? Well, when we look at a balance sheet, a business, all it is a balance sheet. It's just a list of stuff it owns called assets. list of stuff it owes called liabilities, and then the owner's interest in those assets, which we call owner's equity. And what this tells us in 2021, the debt ratio was 27%. So this means for every dollar of assets we had here, so this is telling us what percentage was financed by debt. So this must mean 27% or 27 cents of that dollar of assets was financed with debt, and the owners therefore have a claim to 73% of the assets. But in 2022, it's gone to 42%. What does that mean? It means for every dollar of assets here, liabilities now represent 42 cents or 42%, which means 42% of your assets were financed with debt, and the owner's equity claim is only now 58 cents. So that's a bad trend. It's gone down. We've got proportionally more debt than we did a year ago. And finally, we've got our return on owner's investment, and that is our net profit divided by average capital, and it tells us for every dollar of capital invested by the owners, how much net profit is earned. And this is a profitability indicator. So in 2021, this tells us that if the owners had $1 of capital invested here in the business, because we said business is just a series of assets, liabilities, and owner's equity, for every dollar you put in, the business was generating 9 cents or 9% net profit. In 2022, for every dollar of capital the owners had invested, it was now generating 12 cents in net profit. So that's a good trend. So our first question was, provide 2 benchmarks the firm could use to evaluate its return on investment ratio for 2022. So to answer this one, we just need to go back. We said basically with any number, in any indicator in business, there's 4 things we can compare it against. The past performance, what was it like in previous periods? Did it improve or deteriorate? We can also measure it against the budgeted performance. What did we hope to achieve? So when we did budgeting in Chapter 17, and was it better or worse than that? We can also compare it against the industry average. So compare it to similar businesses in our industry and were we better or worse? And for ROI, because that's measuring the return on your investment, you could go, well, what else could we have invested the money in? What are the alternative investments? Did we even have to put the dollar of capital into a business? Could we have bought a property or invested it in shares or whatever? And is our business returning more or less than that? So it doesn't matter which 2 here, but I went with the first benchmark was past performance, and I only went with that one because we have data on it. The ROI has increased from 9% to 12% from 21 to 2022, which means that we're making an extra 3 cents of net profit for every dollar of capital made by the investors, and put into the business by the investors, and that means that is a good result. And the other one I put in would be alternative investments for ROI. That's always the big one. If you're doing economics, this is your opportunity cost. The owners of the business can also compare the rate of return of 12% against what they would get from alternative investments such as shares or term deposits. Then we had a really difficult question. 6 marks for a written question is about as big as it gets in accounting, and it's quite difficult. We were asked to explain the trend in each of the indicators provided here. So explain the trend. And then, what was the possible impact on each of receipt 32, which is this one. However, what's not on receipt 32 that we need to talk about is it says we bought a van, but the question also said this van was financed with a loan, so we need to factor that in too. So why don't we just look at each of the indicators separately. We'll start with the cash flow cover. And this one got worse. It decreased. Why? Well, I guess some possible reasons, and we don't need to talk about all this, but one reason is you would think a van would help us increase sales and net cash from operating activities, so that would be the number on top. Yet, this indicator went down, so I guess it must mean that's because the van was bought with a loan, and that increases current liabilities proportionally more than any cash we generated here. Long story short, current liabilities went up more than the subsequent increase we were able to make in operating activity cash. What about the debt ratio? That one increased. Why? Because whilst the van did increase total assets here, 100% of the van was bought with a loan. Now, in 2021, only 27% of our assets were financed with debt. Now, if we go and buy another asset and we buy it with 100% debt, mathematically that makes this ratio go up. So, and if we were to keep this ratio the same, from 27% in 2021 to 27% in 2022, we would have needed to have bought 27% of the van with a loan, but we bought 100% of the van with a loan. So therefore, when you're increasing total liabilities proportionally more than total assets, therefore this indicator here increased. And lastly, ROI. This one got better. Why? Well, I guess a possible reason is it increased sales to customers and net profit. And then we should probably note that it would also have depreciation expense. The question mentioned that. It said it was going to be charged using the straight line method. Yeah, so we should say, well, obviously increase sales and net profit more than the increase in depreciation. Another possible thing is we could say, well, because this debt ratio got increased, that meant capital as a percentage of total assets was much smaller, and that would also increase your ROI. That's a really complicated answer. You might want to leave that one. So setting our answer out, you can set it out however you like, but I did write it so it looks like to help you and go, we'll probably talk about it in 3 groups of 2, but you can do it however you want. But I thought it made sense to talk about, says explain the trend in each of the indicators. The cash flow cover decreased so that for every dollar of current liabilities the business has, its operating activities are generating only $1.50 in cash to pay them, compared to $3.60 before the van was purchased. That very clearly explains the trend. But now it says explain the possible impact of receipt 32 on each. So I said this occurred, this trend here, because while the van helped increase sales made to customers and therefore net cash from operating activities, it was bought with a loan, and that loan increased current liabilities proportionally more. We need to say current because the cash flow cover only looks at current liabilities. So that's our first indicator done. Let's have a look at the second one. I went with the debt ratio increase from 27% to 42%. Explain that trend. This means that in 2022, a greater percentage of the firm's total assets are financed with debt or liabilities than before the van was purchased. So we've done that bit, explain the trend. Now explain the impact of buying the van in receipt 32. And I said this occurred because while the van increased total assets, it was 100% financed with a loan or a liability. Whereas prior to the van's purchase, liabilities only financed 27% of total assets. So therefore, the debt ratio increased. And finally, I went with the ROI increase. So I'm explaining the trend. It increased from 9 to 12. So that's not explaining, that's just stating it. And this means that for every dollar of capital invested by the owners, the business generated 3 cents more in net profit after the van was purchased. So I've explained the trend. Last bit, explain the possible impact of receipt 32 on each. This occurred because the van helped the business increase sales to customers, which increased net profit, more than the depreciation expenses incurred against the van in 2022. And there we go, the 6-mark answer broken down into 3 mini questions, 3 sets of 2. And that's a really good strategy to use when you're getting these big 6-mark written questions.